this week, you were asked to choose an automobile, vehicle of some type that you would like to purchase. And today I'm going to go over the handout on how would you figure out your interest and your payments on that. So the example I'm using here is a 2001 Toyota Sequoia with 120,000 miles because I want to have it paid off very quickly. Cost of the car is $5,000. Now I've saved up $500, which means I'm going to pay that up front. So I'm only borrowing $4,500. And that's called your principal. So let's look at my three definitions here. The principal is how much you're going to borrow. The rate is the interest rate that is being charged by the lender. That means the bank, or if you're getting financing through the car dealership. And then the time is how long the loan is in years. So our formula that you may have heard before in math class is principal times rate times time. That's going to give you just the interest in dollars. That's also called your finance charge. And on this next line, you see how you're going to take that principal, remember that's how much you borrowed, plus the interest, how much you have to pay to borrow the money, equals the maturity value. And that tells you how much you have to pay back in total over the length of the loan. So let's look at situation one here. We've got the Toyota Sequoia. The $4,500 loan is at 8.5% for 3 years. So if I take principal times rate times time, I'm going to take 4,500 times 0.085, that's how you write that as a decimal, that's your 8.5%, times 3 for 3 years. So I have $1,147.50 in interest. Now on the next line, let's add that to how much we borrowed. We borrowed $4,500 plus $1,147.50 in interest means we're going to pay back $5,647.50 total for this car. Now I'm going to take that number divided by 36 payments, because if I'm paying for 3 years, I'm going to pay every single month. That is a total of 36 months of payments. 12 months in a year times 3. So if I divide the total that I'm going to pay for this car by 36, I get a $156.88 monthly payment. Now just so you know, there will probably be some other fees that will be included that would be rolled into this. You might have them put the registration and title fees in your loan and everything else, and that would make that monthly payment go up. This is just a very simple interest formula for just getting an idea of what that monthly payment might be. Let's look at situation 2. Same vehicle, same amount of principal, but we're only going to borrow for 2 years, so notice even our interest rate goes down. If you have a shorter loan, they will charge you lower interest typically. So let's take principal times rate times time again and take 4,500 times 0.08 this time times 2 for 2 years, which means we will be paying $720 in interest or finance charges. If we go to this next step, we're going to add $4,500 plus $720 in interest, which is $5,220 total. We're going to divide that by the 24 payments for 2 years, and that comes to $217.50 per month. So in situation 1, we were paying for 3 years and paying $156.88 per month with a slightly higher interest rate. In situation 2, we are paying more, $217.50, but notice the interest is $720 on the 2-year loan and over $1,100 on the 3-year loan. So compare these two loans. What is the advantage of the 3-year loan in the first situation? Most people would say the advantage is that you have a lower monthly payment. Number 2, what's the advantage of the 2-year loan? Well, that's obvious. We paid less in interest. So not only did we get a better interest rate, but we paid less in interest because we paid it off faster. You just have to be able to afford that higher monthly payment. So earlier this week, you were assigned to pick out your own car. So in situation 3, let's look at what it might cost to buy that car. Here's the one I picked out. It's a 2017 Buick Regal Turbo Sport Touring with only 10,800 miles, and it is certified pre-owned. So let's say I talked the dealership into selling me that car for only $18,000, including all taxes, all fees, all registration, 18,000. So whatever car you picked out, you will fill out this form. So I've got my car, and your make and your model is like the maker and the model, and you can delete those extra lines so it doesn't wrap around like that. And I'm getting it for $18,000. So I need to take that times 10% to figure out my down payment. So I'm going to go to my calculator. I'm going to take $18,000 times 0.1, that's 10%. $1,800 is my down payment. So I'm going to put $1,800 is my down payment. Principal is the price of the car minus your down payment. So I need to take 18,000 minus 1,800. 18,000 minus 1,800. $16,200 is my interest. 16,200. Now, the bank agreed to give us a 5.9% interest rate, and we are going to borrow for 3 years. Let's fill in our formula. Principal times rate times time. So the principal is 16,200 times the rate times 3 years is going to give us the interest, just the interest alone that we're going to pay for this. So take this times 0.059 times 3 years, 2867.40. There's our interest. Now let's add the principal, 16,200 that we borrowed, plus the interest that we have to pay on this loan to get the total that we have to pay back over 3 years' time. So I will just hit plus 16,200, the price of my car, $19,067.40. Now, here's where you figure out what you're going to pay every month. Monthly payment. Take the principal plus interest, which we did right here in this one. You just did that. And divide it by the number of months, not years, that you will make payments. So I need to take 19,067.40 divided by how many months are there in 3 years. I hope you said 3 times 12 equals 36 months. So I have to divide that by 36 months. So divided by 36 payments, $529.65. Or you could round that up to $530 a month. That would be fine. Now, how much extra did we pay for this car? We had said that principal plus interest is $19,067.40. But don't forget that we also I paid an $1,800 down payment. So I've paid over $20,000 for this car. I'm going to subtract out what the price of the car was. $18,000 was what I talked the dealership into. I have paid an extra $28.67.40 for this car. Make sure you know that you're talking about dollars and cents here. So the big question is, what did I pay to have to borrow that $18,000 as opposed to paying cash. I had to pay an extra $2,867.40 for that car because I had to borrow the money from the bank or the car dealership. They will loan you the money too, but that's a whole nother conversation. Now, take the car that you picked out on the assignment earlier this week and fill this all in and share it with me. Thanks.